they might go up in the future. On the flip side, if we do go into a recession, which is not our base case, then you would say, okay, we were actually a lot more restrictive than we thought, and neutral is lower.
Aditya, appreciate your insight as always. Looking for 25 in 3 minutes' time. Aditya Bava there of Bank of America Global Research. I'm pleased we got to this discussion. Equity markets close to all-time highs. Bond yields are low. Spreads are tight. We've had a round trip through the whole of August. And think about the demand we're already seeing for debt worldwide, across Europe, here in the United States as well, both sovereign and corporate. And look at what's happening with mortgage applications in America. Before we've even seen the first interest rate cut, we're already starting to unlock a lot of activity. Big move higher, TK. Big move higher this morning.
Which to me just highlights the reason why people treat the markets as though they're an adolescent looking for more, and you give them a little bit and then they're looking for even more. This idea that if the Fed says, fine, you guys can have your 50 basis points, then they're going to keep going with that, and that's going to create much easier financial conditions.
Quickly, Peter Orszag at Brookings with a terrific 3 essays, Mohammed, on what the pandemic did to our microeconomics of our system. Are we still in the pandemic?
No, I think we've mostly exited, with the labor market being the last sector to adjust.
Do you think we're in bubble territory here? What do you think about some of these market moves? The fact we haven't even seen a rate cut yet, and we're already at these kind of levels.
I think we've gotten carried away on the fixed income side, both on...
Bonds more than stocks?
I think bonds more than stocks.
Why is that, Mohammed?
I think stocks, you can make stories for secular changes, for real transformational changes. I think in the bond market, you can't make that argument. If you make it, then you should go the other way, because we have fiscal deficits of 6 to 8%. We have high debt levels. The secular argument isn't in your favor in the bond market.
2 issues in the last few weeks. We've talked about them. We had debt out of Italy, record order book. The week before, we had debt out of the UK, record order book. We saw some of the busiest days we've ever seen in the high-grade corporate market in America. Tons of demand to back it up.
And when you ask people why, they say there's cash out there and people want to lock in yields before some of those rates go down. I love this story idea, but basically you can come up with a story for stocks. But this if you're storytelling, stocks actually make more sense right now than the story that is the bond market.
What did you say this morning? This is a market where logic comes to die.
Yes.
Isn't that what you said?
Yes, that is what I said.
That's my line of the month. My line of the month. This is the countdown to the Fed decision. It is literally seconds away. Going into it, your scores look like this in the equity market, firmer by about a...
Can you hear me now?
On the S&P 500 on an 8-day winning streak. It looks like this in the equity market, firmer.
Can you hear me now? Initial reaction is bullish. Okay, you guys can hear me now. What in the world, dude? Can you hear me now? Initial reaction is bullish. Okay, you guys can hear me now. What in the world, dude? All right, let's see here. Initial reaction is extremely bullish. Look at that move. SPY calls up 137%. Wow.
In the bond market, 2-year, 10-year, 30-year, your scores as follows. Your 2-year yield in America has been moving lower over the last month. Your yield 3.65. Your Fed decision with Mike McKee.
It's 50, and the promise of another 50 basis points in cuts by the end of the year, and another 100 basis points in 2025, which would put the nation's benchmark rate at 3.4%. It's projected to fall another 50 basis points in 2026, which would put the rate at 2.9%, which is now the Fed's median forecast for the neutral rate. That is up a
50 basis point cut.
The consensus is GDP will rise 2% this year, down a tenth from the June forecast. Growth will be the same in 25 and 26. Unemployment will hit 4.4% this year. That's an increase from the June figure. It will fall to 4.3% in 2026. PCE inflation of 2.3% this year falls to 2.1 next year and hits the 2% target in 2026. Though inflation remains, quote, somewhat elevated, the statement says they cut because they now have greater confidence inflation is moving sustainably toward their 2% target, and the risks to inflation and the labor market are roughly balanced. While they do not explain why they decided on a half-point reduction, the statement says the committee is strongly committed to supporting maximum employment. And remember, in Jackson Hole, Chairman Powell said any deterioration in the labor market would be unwelcome. There was one dissent from Governor Mickey Bowman. It's the first dissent by a Fed governor since 2005. It is the first dissent by any member of the committee since 2022. The statement adjusted to say the committee will, as always, carefully assess incoming data, quote, in considering additional adjustments. There's no changes, guys, to the QT portion of the Fed's policy.
Mike McKee, stay close, we'll come back to you. Here's the price action in response to it. Knee-jerk reaction, it's the first move. Might not stick, but this is the move so far. Up by 0.8% on the S&P 500. The overwhelming outperformance on the Russell. The small caps now up by 1.7%. In the bond market, just bear in mind, we've come a long way. And we've priced in a lot to this yield curve. The 2-year just climbing just a little bit to unchanged at 360 at the moment at the front end of the yield curve. And in the FX market, dollar yen dropping back by about 0.7%. So that's a weaker dollar, a stronger Japanese yen. Lisa, 141 on that currency pair.
Yeah, now
I bought a firm calls right there, small.
Divergence continue. I also want to point out gold. We're seeing
On
a
this
big
breakout.
gold right now. We start to look for some of the inflation proxies. So will this sort of feed into that idea? I thought it was interesting. The long end of the yield curve, just on the margins, not significantly, yields just slightly up on this idea that they're going to go bigger and potentially even more down the line.
So the median dot can mask some disagreement beneath the surface. So let's talk about the range and not just the median at the FOMC. The median dot for 2025 in the projection materials that were just published is 3.4%. The range for 2025 is anywhere from 2.9 to 4.1. 2.9 to 4.1. That's quite a range on this FOMC. And I think for the first time in a long time, we have some dissent playing out publicly as well. The first dissent from a sitting governor on the FOMC since 2005. This was not a unanimous decision.
And it really highlights why this actually became such a knife's edge kind of decision. Just to add to that, 10 officials penciled in 100 basis points or more of cuts for this year. 9 officials penciled in 75 basis points or less for this year. It actually matters quite a bit for market expectations, especially given some of the policy uncertainty next year.
So TK, we get 50. We get 50, and now we're waiting for the next act. It's a news conference in 26 minutes' time.
I think it's a surprise. Within the zeitgeist, this is to the edge of surprise. I think Powell maybe alluded to this with his enthusiasms at Jackson Hole. You touched on something Jason Furman touched on this morning, which is don't forget the dollar. Larry, and I'm going to be as direct as I can. Is the great unknown here a dollar weakness that anybody without gray hair doesn't know?
That we may not know. I think we've seen it before. I remember periods of dollar weakness, but it is dollar weakness. This is not just a 50 basis point cut. This is a dovish 50 basis point cut. Right? I mean, now, I agree with you, John, that the dovish part comes from the median dots. But if you look at the range, it doesn't look at dovish. But that's not what the market is going to hear. The market is going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
To some extent, this median dot validates market pricing coming into this decision. Is that sufficient? I'm looking at equity market reaction right now. We're up by 0.5%. We've still got a news conference, a question we've asked for the last several weeks into this. Are we going to end up with disappointment on the other side of this news conference with Chairman Powell? What would your question be now?
So first of all, normally he's more dovish than the state.
Good move at a DAB
this time.
RG, really big move.
You know, my question will be, what has changed since July when you decided not to cut rates? And now there's this very aggressive cut and aggressive signaling. What has changed?
The speech in Sintra, Portugal at the start of summer, very different to what we're hearing from the FOMC just several months later. Joining us now to discuss is Bob Michael at JP Morgan Asset Management. He joins us out of London this afternoon. Bob, we just want your first impression to the decision. What do you make of it?
It hit on pretty much everything we were looking for. probably a little less dovish than we thought in two instances. One, there was a dissent.
Really good move out of BTBT.
Would have liked to have seen the median.
Excellent move out of here.
Next year, somewhere around 2 3/4 to 3%.
Those calls are printing.
As we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michael right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just the Fed a long way from neutral, perhaps as Mohammed.
You can't call it emergency. It's been telegraphed for ages. What an idiot.
The cycle.
This guy's an idiot.
So they're starting to get towards neutral. All is well.
Having some retracement as expected.
Was an increase in mortgage applications. What we've seen is already the bond market pricing in all of this.
Affirm.
And basically, this statement only encourages that even.
It's holding up.
Do you not see a risk of potentially reignited inflation, Bob, that we could potentially see expressed in the long end? As Mohammed was mentioning, we are seeing that yield curve steepening in a way that hints at something else is amiss, especially when paired with gold.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflationary. There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, the low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
Bob, I know they call you Bob Michael, but you told me earlier it was Bob Michel, so I'm going to stick to Bob Michel. Bob,
Mohammed, I came to London because I thought we were going to QPR Millwall on Saturday.
IWM stronger than SPY right now.
I'll be in London tomorrow. So Bob, speak a little bit to the revisions in the projections and particularly unemployment. What do you make of that?
I didn't catch them. What did they do?
They pushed it up.
Yeah, I think they have to. I think they have to acknowledge that we're at a challenging time, that there are new entrants to the labor market, but those are still unemployed U.S. workers.
Get up over
and
here.
They have to acknowledge that we're not below 4% anymore. We're heading a little bit higher, and that's why you need the policy response to start with 50 basis points. I'm okay with that.
Yeah, but Bob, I think we've got to talk about this a little bit more, and I'm pleased we went to unemployment. Unemployment right now in America is at 4.2%. These are the Fed's projections out in 2024 year end, out to 25 and beyond. They've got projections of 4.4%, the median projection for unemployment this year. Next year, they've got it at 4.4%. Given the move we've seen over the last 12 months, Bob, how aspirational is that? How realistic is it that we just kind of pause around these levels for the next 18 months?
Well, we very well could. If we get 225s over the next two meetings and we bring rates down 100 basis points, what we know is there's still a shortage of housing. There are first-time home buyers queued up to buy homes. So bringing rates down could bring those buyers into the market. We also know that a lot of businesses don't fund themselves in the public bond market. They fund themselves through bank loans, through private credit. Those are floating rate loans. Those are anywhere starting with SOFR at 5 3/8%. You take 100 basis points off of that, that could help to stabilize things as well. Just because unemployment has headed up over the last year doesn't mean it has to keep going. It can certainly flatten out here if the Fed does its job.
Hey Bob, appreciate catching up as always. Bob Michael there of JP Morgan Asset Management. There's a couple of moves in this market that I think are very, very interesting. We've just gone 50, and in some ways the dot plot is validating what we were pricing in this market ahead of time as well. And what you're seeing at the long end is the long bond sell off and yields climb by 2 basis points. It's not a big move, but it's notable. We're up by 2 on 10s, on 30s we're up by 3, and at the same time we've got gold at all-time highs. What is this market sniffing out?
Well, it's sniffing out on the margins a greater inflationary risk than otherwise priced in. Look, I could make an argument about how it might mean that we're going to suddenly get run away into 70s-style inflation. That's not what it's saying. But what it is saying is that on the margins, the idea of a bigger and, frankly, a dovish 50 basis point rate cut really highlights how inflation is still back on the table, at least on the margins.
They're talking about a dual mandate imbalance. Mohammed, your impression is that it's a single mandate central bank now. And you don't think we should take our eyes off the other side of the mandate? Do you think the market's speaking to that, just on the margin, this afternoon?
I think at the margin, yes, but I do think that this is the reaction of a single mandate Fed right now, especially if you believe 2% is the inflation target.
Let's cross over to Dan Swunk and bring her in of KPMG. Dan, we'd love your thoughts on the decision, and then we can get into the nuances. What do you make of the 50 instead of the 25?
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about. And Mickey Bowman doing a dissent, Powell willing to take a dissent among the board members as opposed to among the president. That is how much he wanted this 0.5% rate cut. And I think that's very important. I think you're going to see it couched and explained within the context of several participants at the July meeting thought they were ready to go ahead and cut. So this is a bit of a catch up to that. And so that should help temper a little bit this dovish read on it. I was surprised that they kept the risk balanced, although clearly the focus is now on employment and not allowing the situation in employment to become much worse. Remember, we're at 116,000 payroll gains, 3-month moving average as of August. That's not statistically different from zero. Combined with the downward revisions we saw on August 21st, the day before Powell gave his remarks at Jackson Hole, those downward revisions, record downward revisions, even if they're not as large as they appeared because of some immigration that we're not capturing, they're still large, and it means the birth and death rate, the death rate of firms has picked up, and their small businesses aren't hiring as much as well, which could mean actually the payroll data for this year also gets revised down, and that's what they're worried about.
Diane, your work out on LinkedIn has been just hugely beneficial, a really holistic view of the U.S. economy. I have a Dow Jones Industrial Average, bottom of the pandemic, up 128%, 21% per year. I've got debt and deficit that Hal Bronner and Bernstein never dreamed of. Diane Swunk, is this a Fed just dealing with our stimuli? Is this a Fed just dealing with debt and deficit to the sky?
Hey, I'm live on YouTube right now.
What's the update, brother?
Everything you could possibly imagine.
50 basis point cut.
And now we're seeing it come down despite the fact that we still have a lot of debt. So, on the margin, yes, we do have high debts, and I do believe we need to deal with that at some point in time. And I don't think we have anyone who's willing to talk about it on either side of the aisle, which is another issue, and we can talk about that at a later date. But right now, we've got a Federal Reserve that's no longer buying that debt, and you've got a Federal Reserve that is seeing inflation come down despite the fact that we have high debt. And that's because on the margin, after we get past the sort of 6 months that we put a whole year budget into, from March into October 1st, you get a continuing resolution at best through year end, and you're going to get more constraints on spending, I think, as we get into 2025.
Diane, one reason why this comes as a surprise.
Yeah, the dollar's melting.
One reason why is because they could have telegraphed this more carefully. There was no data that really moved the needle between the time when the quiet period
And it's holding the move.
now that would shift us toward 50.
SPY's catching a bounce here.
Clear communication that this was a Federal Reserve ready to cut rates by 50 basis points.
A firm's bouncing right out of the hole.
Frankly, I don't
Man,
think
that thing
Powell
was
had to
brutal,
back up very
retracing it,
quick.
but
Had
it's
the
coming
bullets
back
in his
now.
pocket to be able to do that, and I think we saw that in some of the mixed messages, even the day of the blackout period. Chris Waller, governor on the Federal Reserve, had said, you'd be open to a more aggressive rate cut, but he didn't seem to be really ready to do it in September. We saw John Williams come out that same day and sort of talking about more cautious rate cuts, more of a quarter point kind of rate cut. So they didn't telegraph it because he hadn't corralled the cats, but this really does speak to the fact that he does have an extraordinary ability to actually do just that.
Let's get to this quote from Neil Dutta of Renmark, just out at the moment. Here's the issue. The balance of risks have changed. In June, most saw balanced risk to unemployment rate. Now, this is completely flipped. Most see risk to unemployed skewed to the upside. This will not be the last time we see a 50, in our opinion. Lisa, your thoughts?
This is basically what's being priced into this year. I mean, how else do they get to more than 100 basis points potentially by the end of this year? And if you think about it,
Small caps are just
a lot of questions about
holding the rallies very well.
Makes that such a consensus, given that we've gotten a lot of mixed messaging.
Let's head back to London and catch up with Bob Michael at JP Morgan Asset Management. Bob, I'm sitting there in cash. I've been sat here for a long time. You've been warning me for a long time that I face real reinvestment risk. The Fed's just cut 50 and I'm freaking out. I give you a call. I'm now worried about maybe
the small account's looking great right now. The baby account
We're telling clients just
is all the small caps right now.
just get
IWM,
into a general
holy.
bond fund. It could be an
Yeah,
active
and SPY's going back too.
bond fund, could be a core plus bond fund if you're in a high tax bracket.
Cancel
Get
the
into a
crash.
general
Okay.
municipal bond fund. Yields are
Cancel
coming
crash.
down.
No, this looks really good right now.
Level.
I don't know if it's just because I'm watching the stream too, but I hear you guys through the stream and in the chat.
The bond market.
Yeah.
Yeah,
Buying has
PSBs.
brought it down here, and this money will come in because they're going to watch the return on cash go down like power windows.
I gotta say, Mohammed, this goes to the point that you were making. I'd love your comments on this. This idea that
Buys
the Fed
implied move
was
is
seeing
like
something
$10
that made
a
him
day.
shift his view, and what we're seeing right now is that maybe he just didn't have the votes. I'm just trying to wrap my head around what that means going forward. That maybe they're going to be even more aggressive than the market previously thought, and that maybe it is appropriate to price in even more spread compression, even more yields going lower.
So it would not surprise me if that is a market reaction. It would not surprise me at all.
Yeah, how do I get rid of that annoying
Addition to
echo?
ask for more and more.
What echo? Is it for me?
No, it's from DSB's stream. Just mute it. Or
I
stop
can't.
on
I did mute it.
I'm not in a stream.
Oh,
Right,
never
but
mind.
he's
Got
live
it.
streaming.
Got it.
Oh, that's why they're getting the. All right.
Yeah.
So it wouldn't surprise me if that is what happens. I will go back to the significant dispersion in people in FOMC members' view as to what the destination looks like, and that dispersion has got to be reconciled over time. So I don't think it is as clear cut as the market will make it seem.
Diane Slark, I got 8 ways to go here. Let's try this. You've got a wonderful reading of America away from 3 zip codes in Manhattan, the quadrants of Washington, D.C.
We've got 10 minutes till Powell speaks. Market's trying to retrace back to the upside ahead of it.
People enjoying NVIDIA to the moon.
Well, this is really important because the rate cuts, the short-term rate cuts, are what come through on loans that consumers take out. This is beyond the mortgage rate situation. This also helps the mortgage rate situation, obviously, but the real issue for consumers are short-term interest rates and how they are priced on their debt. Now, on the credit cards, the average credit card rate is about 25%. This is a rounding error on that. It's not going to help a lot on that. That's just incredible how high those rates are. But when you get into auto loans, when you get into other kinds of loans that consumers take and businesses, middle market through small businesses, it affects all those loans. And right now, you can imagine a lot of people are going to get some relief in terms of that. Now, the good news is there's not a lot of overhang of debt for consumers, and they can service the debt they've got. But for those lower income households that have already exhausted all of their savings and then some, this is good news. They rely on lower rates to buy used vehicles. They can't even afford to buy new vehicles anymore. That goes right up into middle income households. So that's where we'll see some movement, but it's not immediate. You're not going to see, the Fed also understands there's lags. And I think Mohammed is right about the issue of the market front running.
Selling back off.
The message here is that this was not signaling that we're ready to cut. This is a window of opportunity to cut now, catch up on July. That's important, but this isn't a signal that they're ready to go 0.5%, sort of continuously. And the election is an uncertainty. That is not factoring into the decision today, but it is an uncertainty in terms of policy for 2025 and 2026. And that could change the trajectory for the Federal Reserve once that cloud of uncertainty regarding the election outcome in the U.S. is lifted.
Could not.
There's your music. Oh, if Spix holds this 5,700, we could squeeze a lot higher, get right back over the highs, and have a big up day. And I think Google swings here can look appealing. Meta looks really appealing right now. Look how strong it is. IWM looks so much stronger than SPY right now. I don't know what's dragging down SPY. It's just kind of like a mixed bag. Tech's weak. Oracle weak. Cybersecurity week. Flat on banks. Flat on health. Interesting. We've almost completed the move up to 226. And then you can squeeze higher. Some IWM calls. Maybe some small IWM calls for the end of the week here could work. It's probably best to just let him talk. But the 230s right now are going for 60 cents. That's a pretty good buy right now. We've got 4 minutes. I'm still experiencing some premium crush on these firms. I was a little too quick. I was too jumpy. When we get back over here, we really want to get back over this high updated now. That's what you want. And then you can get a real squeeze. It's looking good. Yeah, it came right out of that bear trend. Melted up here. Looking real good. All depends on what Powell says here. I'd keep a big eye on Meta right here. All right. got Noob set up now. So this chat room will track all of Noob's trades, who runs the Noob's YouTube channel. And then this chat right here is tracking my trades. Very cool. In real time. They're paired directly to our accounts. No manipulation. People want transparency. It doesn't get much more transparent than that. Carvana just going parabolic. Keep going up so I can short this.
Damn. I gotta hop off right as Powell starts.
2 minutes. BT going to the moon. The small account. The small account looking great. Back to life. We love it.
In Powell we trust.
Powell we trust.
Oh man.
This is wonderful.
Alright, good luck. I'll be watching. Peace.
Peace.
Even Brittany just texted my family group chat and said, Fed just cut interest rates today by 0.5%.
Yeah. Big cut, baby. So that, you know what that means? That means they literally said, all right, let me get some ice and then I'll say what I'm going to say.
Oh, the bot's tracking my trades. I did not see that. That's cool. I'm a little late to the party, as usual.
Ow! I just stubbed my toe. Did you hear that? That was brutal. Wow.
Oh no. Oh no. By the way, I'm long lows here in March of next year calls.
I annihilated my fucking toe. I stubbed my toe so bad like 5 minutes
here. Do you hear me, Josh?
Yeah, but Pal's talking, so. Why is it so quiet?
Substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2%
Will not stop going up.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint.
Woo! Affirm!
Our policy interest rate by a half.
Affirm's right back, baby. Right back to the highs.
Reflects our growing confidence.
Yeah, Affirm is giving me a little grief here.
Strength in the labor market can be maintained.
Will you short this?
Of moderate growth.
Still am.
Inflation moving
That's ridiculous.
down to 2%.
You're ridiculous.
To continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace.
Affirm can pop to 47 here. That's what we want.
The first half of the year, and available data
Give us the
point
pop
to a
and follow
roughly similar
through.
pace of growth this quarter.
Spix
Growth in
holding.
consumer
Spix
spending
held.
remained resilient.
It defended 5,700.
Hey, Josh, this is not correct.
In the housing sector,
It says buy to open. I sold that to open.
Okay, he's got to, because you trade differently than me, so he's going to have to.
Just letting you know.
Okay, you got to let him know. He's the coder. He's in here. He's not in here. Okay. Well,
he's not in here.
Participants generally expect GDP growth to remain solid, with a median projection of
His name's Asus, right?
over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month.
What is happening with the Russell? This thing is exploding.
Yeah, what did you expect to happen today?
I wasn't expecting the Russell up another 50. This thing has been outperforming for like a week and a half now at this point. I just needed to take a breather for like a week.
If Powell says like we don't think this could be a recession, we're front running it, get ready because it's gonna explode.
The median projection
Yeah,
for the
calm
unemployment
down.
rate in the S&P is 4.4% at the end of this year.
Calm down. You're so dramatic.
Inflation
So
has eased
dramatic.
notably.
Gonna explode.
Remains above our longer run goal.
So we realized we over tightened, and now we're cutting aggressively. Hopefully, we didn't fuck it up too bad. Have a good day.
That total PCE prices rose 2.2% over the 12 months ending in August, and that excluding
Tesla.
food and energy categories, core PCE
Is Tesla finally playing along? Because I need Tesla to play along.
Yeah.
Is that where I'm making money? Is Tesla? I'm printing money left and right here. I don't know where, but everywhere it looks like. Good mother of pearl. Tesla's exploding. MSTR.
in the S&P for total PCE inflation is 2.3% this year, and 2.1%
Lowe's is breaking out above like a multi-year
What's the ticker?
high here. LOW.
Our monetary policy actions are guided by our dual mandate to promote
If it
maximum
can,
employment and stable
this.
prices for the
Has
American
earnings coming out?
For much
Okay,
of the
not till
past 3
November.
years, inflation ran
I don't know. I bought out in March of next year.
and labor market conditions were extremely tight. Our
I
primary
bought
focus
the
has been on bringing down inflation.
300
appropriately
calls.
So. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations
Tesla's finally taking 235.
Wow, there we go.
year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee
Tesla
decided
should
to
get
lower
great
the target
follow-through right
rate for the
here.
funds rate by a half percentage point to
Hopefully.
4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to
Almost
enable
tempted to close
further
out.
progress on inflation as we begin the process of moving toward a more neutral stance.
Now it's quitting.
We are not on
Quitters
any
never win,
preset
Tesla.
course. We will continue to make our decisions meeting by meeting. We know that
There we
reducing
go, the whole
policy
market's
change
falling
could
back here.
hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional
I'm gonna cut
adjustments
some shit that's
to
just
target
not
the
moving.
funds rate, the committee will carefully assess
I'm gonna cut
data,
some of these
evolving outlook, and the balance of risks.
that are laggards.
In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of federal funds
Is this person going? Or are we
4.4%
doing it?
at the end of this year and 3.4% at the end
Oh,
of
I'm still not. I'm not muted, am I? Sorry.
These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy
Feeding
remains
us right
solid
back up
and
to
inflation
highs.
persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly, than
Look how strong it is.
we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our
Bears get eaten right up.
families and businesses across the country.
Yeah, that's
Everything we do is in service to our public mission.
impressive.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman,
I went from being short at the lows in the Russell. I was short the in the money 2350 put.
came out a little firmer than expected. Retail was strong, third quarter GDP running 3%.
And now
What changed that made
I have
the committee go
short delta. It's rallied so much. In like 2 weeks, it's rallied that much.
more concerned about the labor
Because I also have the
market?
short
And I guess,
call.
should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
Bullcrap.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
Sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So, a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back,
who cares?
I talked about this at Jackson Hole, but I didn't address the question of the size of the cut and left it open. I think we left it open going into blackout, and so there was a lot of discussion. Back and forth, good diversity of opinion, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add though, look at the SEP. All 19 of the participants wrote down multiple cuts this year. All 19. That's a big change.
If this rolls over from here, it gets real ugly.
7 of them wrote down 3.
It gets really ugly.
17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. All of this is in the book. Give us some guidance on the pacing here. Would you expect this to be running every other meeting once we get into next year? For example?
We're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down.
IWM rolling over, lots of stuff rolling over. We got to cut a firm here.
We can, make a good, strong start, but and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting,
Ooh, might be able to get a little more out of that.
Hi, Chair Powell. Gina Smiler with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
That's what I want to hear him say. Yeah, market should react really well to that.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
What happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of funds rate relative to what might be expected if you're trying to maintain equilibrium?
I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Thank you, Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure.
That is weird.
We talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on
Tesla literally did contest the 231.
Clearly, payroll job creation has moved down over the last year. This bears watching. Meant by many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
Point about starting to see rising layoffs. If that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year, 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So,
whoa, what kind of time frame, pal?
So that should still be
what kind of time frame?
How sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and
He was stumbling there pretty bad.
significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Hi, Chair Powell. Rachel Siegel from Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be wage increases rather are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is. So we feel good about that. Vacancies over per unemployed is back to, but it's still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
Expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting. I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Really bullish.
Hi, Chair Powell. Neil Irwin with Axios.
We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content
We're
if you were to kind of stick
at a
that
point
level?
where we could look for some
Relatedly,
plays.
You know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on.
You have the same thing on Tesla.
Right. So if you're having millions of people come into the labor,
You have these
force,
wedges forming.
creating 100,000 jobs, you're going to see unemployment go up.
These
So
are very
It
playable.
really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that is actually one of the things
What would be easier to play
unemployment rate to rise. And the other thing is
is
just the slower hiring.
I should just adjust these.
Watch carefully. So it does depend on what's happening.
It's a
on
break
the
of this
supply side.
range.
And on the beverage curve,
You can play the wedge.
Yes. So
Take
we
some
all
profits
felt-
when it tests the
maybe
high.
Not all, but I think everyone on the committee felt
A
that
roll. Look for a
some
lotto
other things were
above.
so elevated that they could fall a long way before you hit the part of the curve. where
Technically,
it's
on the
low.
break of this, you probably just want to
into
break of the lows.
higher unemployment, job loss.
This is a bit weaker
Yes,
than
I
this
mean, I
upside
think
trend.
it's hard to know that you can't know.
So we got a big denial on the
Certainly,
upside
It
trend.
appears that we're very close to that point, if not at it.
See if
So
it'll
that
come
further
bounce off the
rise in
lows
job
here.
Openings will translate more directly into unemployment. It's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
This is bearish right here.
Thanks, Chair Powell. Edward Lawrence, Fox Business.
RSI structure is also
so we've
bearish.
heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%.
Bearish
There's
from the
basically
5
an
minute.
entire generation that has experienced zero or near zero.
The 50 minutes still
federal
looks
funds
fine.
Rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly,
We got the break.
But it feels to me, and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some?
I don't like playing that. I wanted to break the lows.
Yeah, so,
I don't want to play
This
this.
is my 4th presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything
what did
else.
you do?
Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people, and if we get it right, this will benefit the American people significantly. So this really concentrates the mind, and it's something we all take.
Great time to play now.
Put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over
He's
time.
saying the bullish things again.
And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Follow up to that, listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So, housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as
it hasn't broke the range. It's still just a range-bound move.
Over time, that will show up.
We could get rid of this line because now it looks like a triangle.
Several years rather than just one or two cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to
Mara almost at the lows.
Reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
Well, the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got
Bitcoin isn't even down that much. This is just
in many cases. So
horrible selling.
Obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue.
Are you still holding the long calls for Mara?
So
no?
Yep, I'm still there.
Challenging. It's hard to
eating
find
it.
to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult, and
it's just gap below that.
It's not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market.
I'll have to cut these Maras. I'm going to cut my January. I'm just taking too much blood. I need to reset Delta here.
Just following up on some
it's
of
getting
the
too far away from me.
Talk earlier, monetary policy operates with long and variable lags. And I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? We knew it's clear that we clearly
NVIDIA plunged.
Agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path.
The 112 puts could work here for NVIDIA. I think I might wait for SPY to break down. What is that plunge? Was there news? Wow. What a move.
Over the next year.
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates.
I'm not sure if I want to chase that.
That'll depend on how the economy evolves. Our
SPY's eating it up.
Intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin.
That cough is so loud. I almost thought someone's in the office with me.
Recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
To households who are frustrated that home prices have still stayed so high as rates have been high, what do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to
still inside move today.
It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored, and
yeah, I don't like starting the video right here.
People in their daily decisions.
I wait. We gotta be patient.
That's where everyone wants to be. Is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really restores. It will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
NVIDIA leading the way out of the hole.
Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk? Would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were.
Did I miss anything?
You know, after the
No.
CPI number came out, there's a really
Still
small
just being patient here.
probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to.
This is literally just people can't make up their friggin' minds. Everybody is.
Important, of course, but there isn't a
They go one way, then they go the other way, then they go one way. It's like, okay, people, what are we doing here?
Dictate one thing or another. We'll look at each meeting. We'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster
Excuse me.
medium term.
This looks like it's about to
goals. Yeah, so I can't
fire out of the hole.
Right line in mind.
Thanks, Chair Powell. Matt Egan from CNN.
1 minute, let's go.
We discussed earlier how
5 minutes getting
that
bullish.
whatever the
15
right
minutes been bullish.
and nothing else factors in. But in general, can you talk about whether or not you believe
1 hour, it looks like it's about to pop to the upside.
have a say in
This is looking good. We could have a big trade. Could have a big trade. I'm eyeing the 570s for 927. 927, 570s. I'm eyeing those.
What? What's that?
Spy.
Around the world.
Oh, Spy.
I haven't bought anything yet, but I'm eyeing it. I want to see the break. Break this trend line on the 1 minute. I mean, you
For
could probably,
927?
yeah, you could probably buy it now, honestly.
Direct
But it's riskier to buy it now because it could chop into the meeting. It could still chop around
making
here.
monetary policy in a way that favors
It's defending the
people who are in
EMAs.
office as opposed to people who are not in office. So that's the idea. Is that and I think the data are clear that countries that have
Go away.
central banks, they get lower.
I'm gonna keep being patient, but that's
So
what I'm
we're,
eyeing.
we're not. We do
Yeah,
our
look, the
work
prices just came down a
to
bunch,
serve
actually.
all
Look at that.
Americans. We're not serving any politician, any
Prices just
political,
came down a bunch.
Figure, any cause, any issue.
Oh,
nothing.
these-
It's just
wow, these
maximum
premiums
employment,
are wild.
Stability on behalf of all Americans, and that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public, and I hope it. I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week I
Ew.
want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his
Meta has like a head and shoulders on the 1 minute.
Basel III endgame. I'm wondering if you are in alignment with him on those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question. Let me we'll give you the second question. So, the answer to your question is that
If I was, if we look at this,
yes,
if I inverse Meta,
those-
look how
those
bullish that
changes
looks.
were negotiated between the agencies.
See how bullish
with
that
my
looks?
support and with my involvement.
Yikes.
With the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Same if
It's
you
not a final
inverse this,
proposal.
look how bullish it looks.
Putting them out for comment, we're going to take comment and make appropriate changes. We
Doesn't
don't
it?
have a- we
It
don't
looks
have a-
so
a
bullish
calendar
right
date
here.
for that. And as
This
for
is
the other
bearish.
agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come, the comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage, so very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activity. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today was, I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Microsoft's daily
to a shock.
Screensaver's a bear. That's funny.
I don't think so. I don't. There's as I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is.
Tech's so weak.
Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that now. Thank you.
Okay, he's done talking. All right. Now we'll get the real move.
Welcome to the Prop.
Hey noob, did you drink yerba mate when you live in Venezuela? Hey noob, did you drink yerba mate when you live in Venezuela?
We're getting a bearish move. $15 minutes breaking down. One hour's trying to hold. 1 hour just went bearish. This is the real move. Wow, if you look at the end of next week's contracts, the market is really one-sided bearish. Like really one-sided bearish. Look at this. Look at this. 100,000 for 370 expiring next week. 202,000. Look at all these hedges. And then even closer to the money. 22,000. There's literally nothing like that on the other side. Such huge hedges for the end of next week.
Josh, the bot doesn't do the futures trades; it just does the equities.
Well, he the reason we want to get you paired up is because you do more complex strategies than me, and we want to.
No, I was just asking if it does it only does equities, or it's just set up like that.
All right, it's not a completed project; it's a project in process, so it will. It just doesn't yet.
That's what I was asking.
Yeah.
How are we looking?
I'm typing some stuff up right now in the Discord. I'm telling everyone, watch this triangle, be patient, and look for the break. That's the upside. Alright, let's take a stab. I'm trying to buy the... Oh, it's running away from me. Get back here, bugger. You little bugger.
570 calls?
Yep, next week, 570. Start small. Squeeze it. Squeeze it. Squeeze it back to the highs. We broke the downtrend. The 15-minute should be coming back. It is back. The 1 hour now bullish. 4 hours still melting down. Daily getting the green candle. Send us back to 570. Specs is holding the 5700. Squeeze them. Squeeze the bears. They're all loaded up on the puts on next week. Give them the squeeze. Give them the squeeze of a lifetime right here. No mercy. Come on. Come on, baby. Come on. We're up 10%. Don't let these go into the red. Are we going to come back test the trend line? What's IWM doing? Also had the breakout.
That's rude.
Is it a fake out? Defended the EMA, but is breaking down the structure. Back test, defend the back test here. Accumulation. Accumulation. Come on. Fight your way back.
I'm getting pretty darn sick of Nvidia and TLT doing the same exact thing. I'm getting pretty darn sick of Nvidia and TLT doing the same exact thing.
You gotta mute yourself after you talk, because we could just hear the echo. You gotta mute yourself after you talk. Alright. It defended. It defended. It defended. Okay. What are we doing here? We bouncing out of the hole? I don't like how this looks. 15-minute looks fine though. Meta looks bullish. Head and shoulders denial right there. Breakout. Carry us higher. Carry SPY higher. That looks good. Tesla looking good. Nvidia is still looking like a bear. Google looking real good. Came and tested the high right there. Testing this trend line again. worse than EMA Cloud. There's EMA convergence right here that it's struggling with.
According to some shit, the last time only one Fed governor dissented on this decision, and the last time a governor dissented like that was in 2005. And they
What? I don't know.
Weird.
Doesn't mean anything.
I don't think it does.
Might have to cut here. Might have been a big. That's a cut.
Spy.
That's a cut. Fuck.
Wrecked.
No, it's a minor cut. Didn't get wrecked. But it's breaking the structure and it's hard to get out of. Oh, it's so brutal. Trying to get out of this. Alright, I actually got a good exit. Oh, it came to me. Brutal!
DXY under 100 for the first time in a year and a half. Not at the moment, but it was a little bit ago. I don't know why the fucking long-term bonds are up so much. Maybe people just said, fuck it, not buying bonds ever again.
For today.
I mean, like, if I were that guy, if I were, you know, the fucking Bank of Thailand or whatever, I'd be like, I need something better than this manipulate ass shit. You know what I mean? Like, imagine you're the Bank of fucking Peru. Or, like, the Bank of, like, Nigeria. You're sitting there thinking, all they do is manipulate these things. This isn't a real fucking... I can't just hold on to all this.
That's just ridiculous, dude. Everyone manipulates everything.
Yeah, but if you're a central bank and you want... And your ID... And your... It just makes more sense.
It's all predictable how they manipulate it in their favor based on imports, exports, and interest rate differentials. So if you're a central banker with the most data, you're fine. And you can talk to all the other central bankers. Like, they're fine.
But then why are they buying so much gold the past few years?
China's buying more US dollars than their gold.
So is buying gold
Like
a
the when data point doesn't mean anything if you're ignoring all the other data points. You know?
So
you have to look at the totality of the balance sheets for any of that to mean anything.
It's totally straightforward. Are they buying gold to buying US dollars?
I can't hear you. It sounds like you're really far down a hallway or something.
That's because I was pouring coffee, sorry. So are they buying gold to mask how much dollars they're buying?
No, they're not masking anything. Just buying gold.
Oh. $100 billion.
They're literally just crushing everything right now.
Yeah, my balls are getting crushed.
TLT selling
Feels
off,
like-
IWM, but
feels
it's
like
all
my goddamn
range bound.
pager.
It's all untradeable range bound moves right now.
Hey, last time my balls were this busted was when my pager went off.
That was actually funny.
Tesla's still up. I put Tesla on my post-cuts watch list. Roku's still up. I'm tagging Marlo. What the hell?
Biden says he's going to speak about the economy tomorrow.
Bigger Texas admitting to selling his SQQQ. Biden will speak about the economy. What is going on? So, I didn't catch most of what Jerome said. What was his sort of like? What was his tone there?
Biden's still in office?
I love Biden. You know, you want to know something?
I thought he was on permanent vacation.
Biden is fucking helping Donald Trump. Because I think they did a coup against Biden. Biden didn't want to actually drop out. And he was like, ah! And so he calls Donald Trump. And you know what Donald Trump and Biden say? You know, like, yeah, we had a very pleasant phone call. You know, he's a nice guy. What's going on? You know what I mean? I believe what I just said.
That's why he put the Donald Trump hat on.
I also think a lot of the move today is going to come after hours.
It's going to have to, because market hasn't done shit.
Yeah, it's got to
literally unchanged.
Yeah.
Like SPY is going to go down like 5 points after hours or something. Or it's going to go up 5 points. It's going to go sideways 5 points.
Sideways. 5 points
know.
exactly sideways.
Exactly sideways. Kangaroo market. I think depending on if you're on MSNBC or if you're on Fox Business, they call it a crab market or a kangaroo market. Crab. I'm a crab. Noob, I don't think you heard me earlier, Noob. I asked you, you ever drink yerba mate when you lived in the Amazon?
Ever what?
Yerba mate, you ever drink that?
What is it?
It's like tea. It has caffeine in it, but it grows on a tree. It's a tropical rainforest tree in South America. It goes about 30 to 50 feet tall. You just dry the leaves.
I don't think so, man. No, I don't think so. I don't know. We had drank some teas that were down there, but I don't know what they were called. But no, I don't. It doesn't sound familiar.
I guess it's more of like a Argentina and southern Brazil thing.
Yeah, I was more of a coffee guy.
Well, yeah, I mean, coffee is like...
And I didn't really much I didn't really much eat a lot of what the locals prepared because, number one, they weren't the cleanliest of all the groups. Unless I saw them make it, I wouldn't eat it. You don't know how long the dead animal was dead for before they decided to cook it.
You didn't teach them that shit? I thought that was your job to teach them shit.
Well, yeah, but there was a lot of them, and you never. It's not like you interacted with all of them all the time. There was multiple different tribes too. Like there were tribes that didn't live right there with us. They would come by and try to sell you different meats and stuff like that. You could usually get a pretty good judgment of when they killed it by what it smelled like. Some of them would throw salt on it, and that would help.
They're literally just going to trade this sideways. I cannot believe they're trading this sideways. I'm gonna close.
Yeah, it turned out to be a boring day.
I'm gonna close my strangle.
Alrighty, close the strangle, boys. Time to.
Well, I have to close it.
Yeah, no, that was the biggest non-event I've ever seen in my life. Priced in for 50-point move, and we got less than 10. It's still not over yet.
After hours. Maybe just fucking nothing happened. Maybe it's all fake news. That was AI. That was all AI. Well, you know what, Josh? This AI shit is better than what we're thinking. Maybe you're right. Whatever it is, Josh is right. Because there's the AI. Just busting. TLT is disappointing my little soul. I mean, it wasn't for a minute there.
We got 10.
Now we're getting a little movement to the downside here. We're breaking down.
Gold. What's gold? Yeah. Gold's tanking.
Gold's down 12.
I'm looking at GLD. It's down. It was up at 240. Now it's back down to 235, 236.
Well. Did I turn my app on?
Fucking Dow Jones. That's what we're getting today. Would anyone look at that? Not really.
No, the Dow's down too.
Yeah.
The only thing that's up at this point is the Russell, and it's up by 1 point. Now 3.
Dude, you are the Russell muscle, dude.
I adjusted my position today. Finally.
The Russell muscle.
I bought back all my positions in the Russell and sold the 2200 puts to replace them.
This is unreal, dude. What a nothing burger.
I think DSB is right, though. It's all going to just happen after hours.
I mean, it could.
I can see clearly now. The rain is gone.
Wednesday's just Wednesday's just that type of.
This is kind of hard to decide what to do next with a move like this.
Yeah, you can't.
Like,
you can't make a decision on what to do next. This is
sit on it, Johnny.
Where's my? I need this market to give me a hook to it.
Hook to
it.
This market. Not even, what does that mean exactly?
I don't know, but it sounds sexual.
It sounds sexual, but I can't tell if it's red or green.
For the record.
Exactly.
Remember when I said bonds would most likely be down? Here we are. Here we go.
Bounced off yesterday's lows.
They don't look very bouncy.
Hey, everyone just put a for sale sign on their house across the street. What's going on? Just wait. So you think the Fed's going to keep to this schedule they just described of 50 points for the rest of this year, which would be like a 25 and a 25 and then 100 next year? Or do you think they're probably going to go a little quicker than that?
Oh.
Uneducated comment here. If the market right now is reacting just oddly volatile, but this is an expected move technically, if you go out far enough, like let's say you have longer dated calls, is it not just generally the right move that it's going to be up in a handful of months, and that this is just people overreacting currently?
People are not reacting at all currently. This is well inside the expected move. There was $50 priced into the S&P contracts on the 0 days today. So the market was expecting a bigger move than this. If we close anywhere inside of $20 up, $20 down, then it's a big inside move. What you'd want to see is a big inside move with volatility really contracting or coming down, but we're really not seeing volatility do much of anything. I think the VIX futures just went from one contract to another, is why the VIX is where it is. The VIX itself is up.
I'm buying this dip tomorrow. If this dip holds, I'm buying it on TLT. Because, damn.
This is going to be a big indecision candle on the daily chart if you look at it. 100% indecision.
You have one big. It was bullish and now it's rolling. Oh, it's fighting.
That girl looks like an angel.
You may have to drop a week or two, huh?
I defended
He's just gonna
those
have.
lows.
He's just gonna. It's gonna chop for like a few days, and then the weekends there's gonna be like bad news with this Israel shit, and then all that together is just gonna be like big red week next week, unless it comes right now.
I'm not doing anything at all. The only thing I did was I scalped the little futures and I sold some firm calls. That's the only thing I did.
That's down. That's what I'm cutting.
Yeah, I'm not gonna do anything else into the close here either. I mean, there's nothing you can do.
You could do all kinds of things. It just probably wouldn't be a smart idea. I lost a little money scalping futures today. I scalped like a chump. Like a chump.
If TLT can hold 99.50.
Yeah, I'm long the bonds here now too, via the futures contracts.
So if it can hold 99.10. Yeah. So.
Mm-hmm. How much longer till I can turn Uber on? Oh, 15 minutes. Okay. Deal with that. Boy, these candles don't look very bearish or bullish. No, they do not.
Shit. Goddamn Weeble, goddamn it. was gonna roll some of these fucking TLT calls further out there, but then they fucking just don't let me because I have to wait a day. Do you have to do that ever, Noob, on Weeble? Does it ever make you fucking wait? Because, like, I can't find the option or anything that's like they don't make you do that if you trade a certain number of times. Noob?
I have a margin account in Weeble, not a cash account.
You don't use any cash account on Weeble whatsoever?
No. Used to be a cash account, but I didn't make that many trades.
Seeing all this war stuff on X, this could easily be dragging the market down, keeping it suppressed.
What war stuff?
All fucking short on the market.
Israeli cabinet has given the prime minister and defense minister the authorization to undertake military action against Hezbollah, even if it leads to an all-out war.
Oh. Well, that's
Trump
nice.
won, dude. Trump won today. Kamala goodbye. That's why I was watching. I was like, Kamala goodbye, because this rate cut is all the news. Like, Israel goes in, market tanks. Is it the rates? Is it the fucking war? Yes. Biden did this. Kamala did this. We're at a war now. We have 2 wars. Oh, the economy is shitting. Trump's gonna win, just like that. This is what I've been saying for like 2 years now.
NVIDIA is taking a dump. NVIDIA puts, actually swinging some NVIDIA puts, some cheap NVIDIA puts can work into tomorrow.
Except for you only have 1 minute left till the market closes.
Yeah.
I'm holding those fucking things. NVIDIA's fuck. I'm still. It just when it hit 90 a few weeks ago. That happened so quick. I missed that.
How's it going, guys? How's it going, guys?
I actually hesitated because of the 1 hour right there. All right. Tight end the stream. What a day.